Hello, our dear viewers. Good afternoon. How are you doing? How had been your week so far? I welcome you all to another wonderful session with Ascent Debt Recovery. Like you know, my name remains Oluwatayo Iyanoluwa Olajumoke, and today we will be, having this conversation about this. It's a trending topic, basically because it affects everybody day-to-day life when it comes to finances. So today we'll be discussing on interest rates and their impact on debt. Yes, we are going further from just understanding what interest rate means to how it actually have effect. Does it even have any effect on loans, on debt? So I would like you all, our dear viewers, to sit down and then join us for today's session. So basically we'll start to say that, like, let me say, I don't know if everybody have a more definition to what interest rate means, but I want you all to know that interest rate is it's a crucial financial landscape. It affects every savings to investment, particularly on loans. Yes, it's not possible when you don't have an interest on your savings, because you need to know why are you saving, what are the things, the benefits you're seeing keeping your money, even down to when you say, okay, you are doing an investment. And now let's not talk about loans, because also just people that are giving out these loans, they are also doing a business, and they also definitely need to make profit. So now for businesses and individuals in Nigeria, it's important for us to understand how these interest rates are being, how they worked, and the impact they have on debt, especially loan repayments. A lot of us don't even understand how these interest rates work. We just do that, okay, you want to borrow money and they're telling you you have to pay an interest rate as low as 0.1%, 1%, 2%, depending on the organization, the financial institution you are, patronizing, you are dealing with. So today, like I said, we'll be having more insight. We'll share one or two things concerning interest rate, understanding, a guide to understand interest rates and how they basically affect loan repayment. So firstly, let's define interest rates for those that are just joining and they don't understand what we're talking about. Interest rates, represent the cost of borrowing money or the returns on an investment for a saving. You put your money in a bank for a couple of months or years, depending on how long you want to save. Definitely there should be something coming on it, which will show that, okay, you're actually making profit for that money you're putting in that saving you're keeping aside. Let's say you're putting your money in the bank. Now, it's also applicable to when you're also saying you want to borrow loan. How? Because those that are giving out that loans to are giving you that money to make use of it for a period of time. So it's important they also make a profit at their end. So their profits, the profit they are making is calculated being using what is called the interest rate. There's a fixed rate on it. And going forward, they can typically be expressed as a percentage of the principal amount, and it can either be fixed or variables. Now, what do we mean by fixed interest rate? This means and remains that there's a constant rate throughout the loan term. It's not like there's a rate attached this month and next month they're telling you it's changed. That's what they mean by fixed. It is fixed, it is certain. Throughout the number of the months or years you will be making use of that money, there's a fixed amount that will be coming on it. So if it's going to be 12% monthly or 12% quarterly, it's fixed. So with the duration of the time that money will be used, it is fixed that, okay, 12% of the total money you borrow is the interest rate you are paying back, which will not change. They won't tell you in the second month that it is changing. Now, variable interest rates means there's a fluctuation. It can change anytime, and this is based, and it's majorly being under a factor of, let's say, there's some market conditions, which we would explain that further. Now, also, it is important for us to understand, like, the different interest rates in Nigeria. Most of us don't know. There's what we call the monetary policy rate. The monetary policy rate basically is a benchmark interest rate, which is determined by the Central Bank of Nigeria. Oftentimes this year, I can share with you that the Central Bank apparently increased interest rates more than once, and this, monetary policy rate actually influence every financial institution interest rate. When this interest rate is being increased, definitely the other financial institutions, like the smaller banks, like all our commercial banks that we use, will definitely also increase their rate. So the monetary policy rate is basically a benchmark interest rate. That is what CBN gives all these other commercial banks, and they basically increase it due to an influence when there is like influence in inflation, which is currently, we all know, it's actually happening in Nigeria, and also, let's say, other economic activities. Now, the commercial lending rate is the interest rates we all are familiar with. Like, say you want to borrow money from all these monetary financial institutions like banks, all other upcoming fintech companies. The commercial lending rate is the rate they put on those loans to businesses and individuals, and most of the time they're actually higher than the MPR, but most of us don't know. Now, how do this rates, how are they being determined? Like I just said, the CBN determines the MPR, which is the monetary policy rate. It is being determined, and it is, when it is being increased, definitely the commercial interest rates are being increased. So another factors that determine this interest rates being high is also inflation. Currently, we all know how things are really expensive in Nigeria. Everybody's feeling the heat, from supplies to feeding to accommodation to transport. Every individual is currently facing the heat, and we all see how it is being, like how everything, the whole situation, and because of that, even the CBN is still increasing the rates, because they actually were trying to see how they can control inflation. So inflation is one of the factors for an higher interest rate, which helps to seek return, to maintain their returns. Another factor is economic condition. Yes, when the economic stability, the government's borrowing, foreign exchange rate, it just started with the dollar increasing over the naira, and they were trying to see how they can manage the whole and bring them to an equilibrium where the dollar and the naira can both be on the same stand. And also that basically had a huge effect on interest rate. In fact, for a layman understanding, you go into market to say you want to buy pepper, and a bookie man is telling you dollar is expensive. It's a typical example for you to know that when the economic condition of the country is also not being stable, it definitely has its own effect on the interest rate. And also another point is demand and supply. When the availability of credit and the demand for loan is high, definitely there will be like a struggle between the two. Now let's talk about the impact on debt. It is very important. Majority of us don't know about this, but we really need to, explain and also make you feel aware. It's important. Now, the first thing is the first impact of when an interest rate is high. The first impact on it on debt is the loan repayments. What do I mean by loan repayments? The interest rate on a direct loan affects the total loan repayment, because before you borrowed 100,000, and at the end of the day you were meant to pay, let's say, 10,000 in addition to the 100,000, which is like 110. But because the interest rate has increased, then you are being expected to pay, let's say, 150,000. The amount you were, that means like an increment of 40,000 to the addition of 10,000. So which means you're having like 150 to pay in returns, and instead of you paying 110, you're having 150 to pay in return. Now that increment of 40,000 is definitely going to affect you when you want to repay, because the amount you are budgeting before was 110. You already structure yourself on how to pay this money, and now because it is times 4, you have to work times 4 harder to pay that money, and it's also going to have an adverse effect on yourself, on individuals. The struggle, the workload to get the money to pay, and at the same time maintaining other bills, maintaining other social amenities actually affects, that's one of the impacts. It leads from the repayment to affordability and even borrowing decision. When you're not being able to afford your repayments, and then you now start thinking, okay, let me borrow from A to pay B. And doing that, you're getting yourself into more problems, because at the end of the day, you have tons of loans to repay with tons of interest. And also, I also need you to be aware of the fact that every day the interest keep reading, it keeps accumulating, and at the end of the day, when it gets to a stage that it has increased, then it start becoming a bad debt, because you will not be able to pay in the midst of you trying to sort every other bills. You have a lot on your head, a lot to pay. And also for other people that say, okay, I'm done paying this one, they might not have the opportunity to now borrow again, because they might have actually default. And these financial institutions or fintechs that give out loans, there's what we call credit score. They are able to view your credit score to know if you are liable, if you are eligible to borrow another money. If they notice, oh, this person defaults, is not trustworthy, does not keep to his repayment structure or his payment timetable, then definitely you won't get access to pay this front again. Before we end the conversation for today, and also on already existing loan, yes, there are some people that are already in this debt. I understand. I know how it can feel. Basically, for variables rate loan, I understand that an increased interest rate leads to higher monthly repayments, which I just explained earlier, because once the interest rate is increased, the monthly repayments shoot up, and for you to pay, it becomes very, very hard, which is definitely going to strain your personal pocket. The money you can use to, let's say, buy food stuff, you have to add it to pay loan. And also, you wouldn't even be able to have a good mental health, because all you're thinking about is how to pay. You don't want this money to exceed the limits of where you will not be able to afford paying. And you don't also want your family members to know. It start becoming adding up to your health, and you started getting worried, and which can have an adverse effect on your mental health. So our dear viewers, I'm going to advise at this point that if you're having any issue dealing with your loan and you need someone to talk to, you can drop a comment in the comment section. We'll definitely read them and attend to you. Thank you so much for joining today's session. Next session we will be talking about effective strategies to maintain and manage high interest rates. Why don't you join us same time, same venue next week? Have a wonderful weekend.